To Paul Mylchreest, who joined Hardman back in early 2018. Paul has been an investment analyst for 30 years now. He began his mining coverage at Crédit Agricole Chèvre in 2005, having previously been an Excel rated analyst in chemicals at SG Warburg, Schroders and Citibank. He also worked for several years as a global macro and cross-asset strategist. Paul, over to you.
Thanks very much, Keith. So if I could have the first slide, please. Yeah, so I think there's a strong likelihood we are approaching the perfect storm for gold and silver as central banks and governments push the current monetary system to its limits. This presentation is going to focus on gold, but I am hopeful that silver will act like gold with an injection of steroids. And please feel free to ask me any questions about silver later. Next slide, please. I think the risk reward for gold and silver is improving. I'm going to touch on some aspects of the investment case. One of them is that there's a war out there between the forces of deflation and inflation. Also that debt cycles are very significant for gold and silver. And I'm going to try and explain how this debt cycle is different to previous ones. And I'm also going to show you how we are currently in an inflationary megatrend. And I've got some charts that may surprise you. If I could have the next slide, please. Yep, so looking at the gold price drivers, in my opinion, they dovetail with today's risks. So we've got a loss of monetary and fiscal discipline, which has only been exacerbated by COVID-19. In terms of the debt bubble, obviously counterparty risk rises as debt increases, and gold is the only financial asset that's not somebody else's liability. You may have missed this, but the FT had an interesting article a few days ago showing how the global inventory of negative yielding debt has now hit a new high of $17 trillion. And obviously that's very significant for gold, which has a 0% yield. And also, not even some market professionals don't appreciate this, but gold is actually the only financial asset which outperforms in both inflation and deflation. And the empirical work on that was done in a book by Roy Jastram called The Golden Constant, which I would highly recommend. Next slide, please. So I just want to move on to the current debt cycle. And as I say there, it's a war. We are stuck in a highly distorted final phase of this debt cycle, which is characterized by this conflict between the forces of deflation, which are inherent at this late cycle stage, and then the inflationary pushback by the central banks to try and keep the global economy and financial system in some kind of equilibrium. One of these forces is going to prevail ultimately, but my point is that either is going to be positive for gold. Next slide, please. So in terms of the deflationary force, that is the global debt bubble. I checked the IIF data a few days ago, so they currently put it at in excess of $258 trillion, or 331% of GDP. Just to put that in some kind of context, debt to GDP in the Great Depression in the US peaked at 275%. So we're really into uncharted territory. You may not have thought about it this way, but debt has a time function. It brings forward consumption from the future into the present. So effectively it buys time. And we've bought a lot of time. And have you noticed how central bankers never actually discussed this huge inventory of debt, which they've so actively encouraged. Next slide, please. So the pushback from the central banks and governments, I would characterize it really as the heavy hand of central planning. I see it really as the opposite of free market capitalism. If you take 6 major central banks that I highlight there, they've created $23 trillion of credit out of thin air since the great financial crisis of 2008. And I think the point is very clearly shown there with what's happened since COVID, that each time the cycle and the debt bubble looks like it's about to collapse, it takes ever more stimulus in order to try and reflate it. Next slide, please. Yeah, so let's put the current cycle in context. This is the 4th debt cycle since the Industrial Revolution. In the table, I show you there the approximate timings of the previous cycles. You can see how the current one is by far the longest. Typically, what you see in these cycles is that the debt builds up and up and up until eventually it overwhelms the system. Generally speaking, it's an equity market crash, which brings on the final winter phase, if you like, of a debt cycle and returns us to the beginning, and the cycle repeats again. The difference really, though, with this cycle is that in the 3 previous ones, we were on some version of a gold standard. This time, we have hyper-interventionist central banks, which are capable of unlimited credit creation. And that's what makes it very difficult. And they are all out to avoid deflation at all costs and to use whatever it takes. Next slide, please. Let me just run you through a classic debt cycle. I'm going to show you several economic variables, but I'll start with the dotted line, which is debt in the system. You can see from the left-hand side of the chart the starting point for each of these cycles and how typically it goes through 4 phases. So in the first one, you have the first spring phase. It's the rebirth of the economy. Debt is rising relatively slowly. You're seeing economic recovery. You then shift on to the summer phase, which is usually in part caused by a major war. So in the first cycle, 1799, that was the Napoleonic Wars. 1861, that was the American War of Independence. Then 1912 and after, you had the First World War. And then more recently in the current cycle, you had Vietnam. And that's the inflationary part of the cycle. You then move on to autumn, which is disinflationary or deflationary as growth slows down slightly, but you have asset bubbles which are driven by the rapidly rising level of debt. And then typically you get the payback into the winter phase as the economy collapses, the asset bubbles are purged. Ready for the cycle to begin again. And it's this phase that the central banks are doing everything in their power to put off. Next slide, please. Here I'm just showing you the inflation rate or the price level. Some people will think of this as the Kondratiev cycle. What you can see with the dark line is that inflation typically picks up relatively slowly in the first spring phase. Then you have the rapid rise during the summer inflationary phase. Then you turn into disinflation and finally deflation. Next slide, please. Interest rates tend to follow, not surprisingly, the cycle in prices. So rising through the first 2 phases and then turning over and declining in the latter 2 phases. And, you know, we're at ZERP or negative interest rates now, which seems to corroborate that. Next slide, please. What I've just put in here is the sort of idealized rate of average GDP growth. So in the early part of the cycle, not surprisingly, it's very rapid, slows a little bit, but still very positive during the inflationary period, and then starts to slow as we get into the autumn phase, basically because the debt level has been building up and is acting as a tax on growth, and then the growth slows or actually goes negative in the deflationary phase. What you can also see along the bottom is the asset classes that you should typically buy or sell during each of those phases. And you can see that highlighting gold, not surprisingly, you want to buy gold during the inflationary summer phase and the deflationary winter phase. Next slide, please. And just to highlight how gold has tended to perform in the final stage of the three previous debt cycles, don't forget, because they have been deflationary, I've not only shown in the red columns the actual performance in gold, but also the real performance. And you can see it's basically wiped the floor with stocks and commodities. If I could find a real estate index that went back to the 18th century, I think it would do the same thing. But the other sector that's typically done well in deflation is bonds. Now I'm just going to move on, if I may get the next slide, and look at how the current debt cycle, we've seen a modification of the Bretton Woods monetary system. That was in 1968 to 1971, but I just want to make a point that it was actually preceded by a two-stage loss in US monetary discipline. The first was in the late 50s and early 60s, when the US budget deficit began to rise. And then the second of the two-stage loss was in the mid to late 60s, which was really due to the deficits resulting from the Vietnam War. But what you saw during that period was that investors began to accumulate gold in the early 1960s. Something called the London Gold Pool was formed by 6 governments who tried to sell gold to keep the $35 an ounce gold cap. And that ultimately failed because they were overwhelmed by gold buying in 1968. And that's when we saw the shift to unbacked fiat currency. So if we now shift to what we've seen since the 2008 great financial crisis, and if I could have the next slide. Thank you. My question is history repeating? Are we seeing another two-stage loss in US monetary discipline? I would argue that we saw the first stage during 2008 to 2015 with ZERP and then QE1, QE2, QE3. And then I think the second stage began in late 2018 when we saw, and I'm showing you on the left-hand chart, the dot plot from the Federal Reserve, where the expectation had been that they would continue to raise rates. And in fact, that's when it turned over and they started cutting rates. And then you can see the US budget projections currently on the right-hand chart, where although I've chopped it off, this year's deficit is going to be about 3.3 trillion. You're looking at trillion-dollar deficits as far as the eye can see. And every time I redo this chart, the bars are higher than they were previously. So my sort of gut feeling is that we're heading inexorably towards a monetary crisis. Unlike previous debt cycles, this time around we have unlimited credit creation, and therefore the likely end game is actually inflationary rather than deflationary, although my suspicion is that everything will deflate, but in terms of gold. And then I just want to say, just as we move on to the next slide, please, that there's one thing that holds me back a little bit from being too upbeat on the prospects for gold and silver, and that's the structure of the London OTC gold market, where some of you may very well be aware of this, but some people still perceive the London gold market as being largely a physical gold market, when the opposite is really the case. Top left is a slide from the LBMA about the different metal accounts, and 95% of trading, and that's an LBMA figure, is basically in gold paper derivatives, something called unallocated gold, rather than actual physical transfers, which is the allocated and very small part of the market. And what I'm just showing you in those other three charts is some of the abuses that you can see in terms of the way the price performs at times. So the top right-hand chart is the average performance of gold during the London trading day. You can see how it's generally on a declining trend, and it tends to do well during Asian trading hours. Bottom left, that's just the green and red charts are 2 successive days of trading in the gold market. If you look, you can see how similar the green and red charts are. That is not really a random walk in my estimation. That is evidence of trading algorithms that are controlling the price. On the bottom right-hand side, I'm just showing you how for several years the gold price was essentially pegged to the yen between September 2012 and December 2017. If I could have the next slide, please. That said, since 2018, some of the banks, bullion banks' abuses of the gold market have been brought to light, and several of them have been charged for manipulating the market. And I think that has been a factor that has frustrated gold's ability to signal what is a very overstretched global financial system. My sense is that the gold bull market will really accelerate when gold bullion settlement in London becomes problematic. And if I could have the next slide, please. So moving from tragedy into hope, to quote Carol Quigley, in my view, it's not so much the amount of gold bullion in London vaults that's critical. And the LBMA likes to say how gold in London vaults is currently at a record. What's important is the float. If you take out the gold that belongs to physically backed ETFs, take out central bank gold, and then take out some gold for high net worths, hedge funds, sovereign wealth, etc. My sense from doing the calculation is there's something in the region of 600 tons of unencumbered gold at most in the London vaults. And bear in mind, if you take the official LBMA trade reporting data, they show that there's something like 1,000 tons of gold trading a day. And that actually excludes non-LBMA members, and the real total could be up to 5 times as much. So my suspicion is that London is ill-prepared really to sustain another sustained wave of gold buying. And I just make the point that the vast pools of Western capital, which are typically wrong-footed by gold bull markets, still hold a very minimal amount of gold bullion in their funds, albeit that this is changing slowly. And if I could have the next slide, please. What this chart shows is the global holdings of physically backed gold ETFs versus the gold price since 2004. And what it actually suggests is that it's the non-official, the private sector accumulation of gold, which seems to be driving the gold price. So that's one reason, I'm very bullish. I see this trend as continuing, particularly if the likes of the BOE and possibly the Fed move towards negative interest rates, which they've talked about going into next year. But let me just put the current state of this battle between inflation and deflation into some kind of context. And I just wonder if you appreciate the scale of the current mega trend in inflation. And if I could have the next slide, please. We are in the fourth great inflation of the last millennium. What I just show you in that table is the approximate dates of the first three. The driving forces for these were often similar. So population growth, which put increasing pressure on available resources, and governments and kings with excessive spending policies. Now, just on the next slide, if I could have it, I just want to show you what typically happened in the final stages of those four previous great inflations. And what you see is that the price index typically rose very sharply towards the end of the first three. The question is, what's going to happen in the current one? But, I have my suspicions that we're going to see a significant increase in inflation rates at some point. If I could have the next slide, what I just want to do is show you the current great inflation, which is the red line, versus those three previous ones. And when central bankers tell you that we're in a period of low inflation, there's a comparison. The people that lived through the second price inflation from 1496 to 1650, they were so astonished by the rise in prices, they called it the price revolution of that period, but it's got nothing on where we are currently. One question you might ask is, how did those three previous great inflations come to an end? And a little bit of gallows humor at the bottom, I say you might want to look away before the next slide, but if I could have it, please. I'll let you guys read those yourselves, but you can see some of the reasons. At best, it's a reversion to sound money. One thing I'd note is in the final phases of the three previous great inflations, food prices increased faster than the general average in the latter stages. I suspect it would be food prices and other essential goods if I could split that out. So we can only speculate what might happen this time round. My suspicion is we're going to end up in a period of much higher inflation. We may see some kind of modification to the monetary system. And, it's worth just noting the World Economic Forum, they are talking about a great reset for 2021. What exactly does that mean? Well, we'll see. If you read their blurb on it, it appears to be a little bit of a kind of socialist utopia. Remember Margaret Thatcher, who said the problem with socialism is that you eventually run out of other people's money. I think in the days of unlimited credit creation, you just print it. And then just to finish off with one more thing, if I could have the next slide. Thanks. That is the gold price versus the S&P 500 since 1971. And that to me is fairly stark, and we'll see where we go from here. Thank you very much.
Thank you very much, Paul. So we're going to have a very quick Q&A session. You've got three questions. Please try to be as succinct as possible, but I suspect you could talk a long time on at least two of the three questions. The first question is, if the new resources of gold in particular are becoming more scarce, more difficult to find, do you think that the large mining companies will become more acquisitive in order to replace assets, or do you think another scenario will play out?
No, I think that's exactly right. So I tend to take my lead from Barrick Gold. 1999, they bought Homestake and Placer Dome, and that was right as the bull market began. More recently, you've seen Barrick take over Randgold and tried to take over Newmont, but it didn't work out. They have great timing. And as many of the smaller companies will tell you, the big companies are good at running mines. They're not very good often at finding gold reserves. So I think it's almost certain, yes.
Okay, so just to go back to one of your opening comments, I think you described silver as being gold on steroids, or words to that effect. Could you just expand on that statement, please?
Yeah, a couple of brief points. I mean, one thing I really look at is the gold-silver ratio, which I think most people would agree at something like 75 looks completely out of line versus history. When Alexander the Great was walking the earth, it was 12.5. When Isaac Newton was the master of the Royal Mint, he set that ratio at 15.5, and most people thought they undervalued silver, and silver left the shores of England, which is one reason we ended up on a gold standard. So I think we'll eventually see some kind of mean reversion. And I think the great thing about silver is it's both a monetary and an industrial metal. Any electronic device you can think of has silver in it these days because it's the best conducting metal. So I think we've now got past the negative impact of the loss of the photography industry, and I think we're seeing growth in industrial demand and investment demand.
Okay, so I think we'll just finish on a very wide-ranging question, which I think a lot of people will be interested in, is how do you play the gold and silver markets right now? You've got certain instruments, you've got certain ways, certain strategies. What would you do? What do you think investors should be looking at?
I guess it depends on your attitude to risk. So if you want to take the lowest risk, you either you buy the metal. So you can buy a physically backed ETF, or you can go and buy sovereigns and store them at the Royal Mint. They're not subject to capital gains tax because they're legal tender. If you want to go out on the the risk side of things, you'd shift from gold into physical silver. But as we all know, silver is very volatile. That's the nature of the beast. And then you're moving through the gold mining majors into the junior players, which should have the highest returns because they are the highest risk. And I think we've put up 3 very good, interesting potential investments here today. But if none of those work for you, then don't forget you can buy ETFs, which give you a broad exposure to a number of juniors.